Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today is Wednesday. It is the 23rd of June, and I believe it may be not the last trading week of the month, but we still have a few trading days. I think we still have a few trading days next week. But with that said, we've got new home sales. We've got the PMI today. Nothing major. I'm not really expecting anything crazy to come with new home sales. We know that supply is very, very tight right now. It has shown itself in the existing home sales report, and I think we're going to see similar in new home sales report. The big report, the one that everybody's waiting for, is the GDP. That comes out tomorrow, and the jobless claims, the durable goods. Tomorrow's the big day for reports, and then Friday we've got personal income and consumer sentiment. Now, consumer sentiment alone is not a major report, but consumer sentiment makes up about two-thirds of the economy. Two-thirds of the economy is retail sales. So I don't see the point of having the consumer sentiment report the day before the GDP. It would make a lot more sense to see it the day of the GDP, maybe half an hour earlier, or maybe the day before the GDP, because again, it gives us two-thirds of the GDP, so it would be kind of good to have it a day before. But what do I know? I'm not the Fed. Maybe we can send a little note to the Fed letting them know they should change their agenda. All right, and then we've got personal income. I'm hoping the GDP is on par. You're going to start seeing a subdued market today. The expectation is right at 6.4. If we're a little bit better, it may be the economy is heating up. This is one of those cases where if it's too hot, it may be too much, and the Fed may be in a position to cut back faster. And if we're too low, then the Fed will pat themselves on the back and say, "We told you that the economy is not moving fast enough." So again, it's a situation where if it's too good, they may cut off the supply. If it's not good enough, they may just leave it alone. So it's a situation where if the economy is too good, it may be a bad sign. It's the impact of the Fed putting themselves in a corner by lowering interest rates a year before they needed to do so. But again, I'm not going to get into that. The bond market is the biggest benefactor of these reports, these federal reports, and then the bond market is what really drives the stock market. It's global currencies, bonds, stocks, and so forth. But that's usually the flow of things. So the bond market, as I expected, it's making lower highs. It looked like it peaked out. It looks like interest rates are going higher. As we expected, the Fed's already changed their timeline, and I'm expecting more sideways choppiness. But with that said, it looks like we're seeing some upside in stocks as a result, and I'll talk about that in a minute. Let me first talk about the economy. First of all, markets are fairly random right now. There's not much going on. And again, I'm not expecting a big day ahead the day before the biggest report from the Fed. So let's talk about global economy, and then I'll talk about more specifics and get into the technical trading action. So U.S. futures rose Thursday. I can't really say they rose too much after Federal Reserve Chairman said that the recent burst of U.S. inflation is probably temporary. I love how it's now probably, helping to calm fears central banks might roll back economic stimulus. Well, we'll see tomorrow. Because boy, Powell is something. Powell said inflation is mostly in areas that suffer supply shortages. He is right about that. I'll give him that. He said inflation that hit 5% over a year earlier in May is likely to subside as economic activity revives. We will see. Tell that to used car dealers. Man, oh man. Preliminary version of a monthly survey of Japan's manufacturing shows June activity weakened and shortages of processor chips and anti-COVID restrictions. Measures of production output and exports orders all declined. Most central banks have kept interest rates near record lows, helping to propel stock market rebound. Investors are wavering between optimism and the rollout of the COVID vaccines and unease that rising inflation as economic activity revives might lead central banks to cut short that support. And again, as I said, if the numbers are too hot, if the report comes out at, like, say, 6.8, then it's going to be worried that it's too much. And then remember, too good is not good right now. Economy overheating is not good right now because, again, it's fearing that the Fed will cut short that support. Cryptocurrencies, Bitcoin is trading under 34,000. It fell below 30, took out a long-term support level. Looks like it's on its way down. Part of the reason is Chinese banks said Monday they would step up enforcement of a government ban on trading, and I don't think U.S. is that far away. The S&P 500 is now in its second day above the 50-day line, although I'm going to tell you right now, we look bullish right now. We look like we're right near all-time highs. But again, if you look at momentum levels, and I hate doing this to you every day, but if you look at the S&P indices momentum levels right now, you will see that only 44% of stocks in the S&P are trading above the 50-day moving average. I want to show you this. So we are actually, as far as the market's concerned, we're coming off of these oversold levels, and I think we're going to go a little higher. But I'm nervous right now because the market is not representing 44% of stocks trading above the 50-day moving average. The market is right now, it's trading right near all-time highs, and that's creating a little vulnerability, in my opinion. I think stocks, I think we will go up, but I'm going to tell you right now, the market is a lot more vulnerable right now. On a technical level, the market should be right here because less than 50% of stocks are trading above the 50-day moving average. So the market is slightly bearish, but it looks like it's coming back up. As far as the tech stocks are looking really, really good right now. And again, that had to do with the fact that interest rates temporarily went softer. Softer rates, better for tech stocks. I'm actually not expecting this rally to sustain itself that much, but if earnings are a lot better than expected on the tech, we may see more upside. As far as all of the major sectors, we're still in a deep pullback on the financials. Energy's coming back really well. Industrial's still on the sidelines. Consumer staples is on the sidelines. Healthcare is looking great right now. Utilities are looking bad, which makes sense. It's a defensive sectors. Basic materials is coming off right now. Communications is looking really good. Energy, communications are looking great right now. Consumer discretionary starting to pick up. Technology is looking killer right now. And real estate, so-so. So again, we're kind of back in the twilight zone between the blue chips and the tech stocks. So in that case, pullbacks. Focus Financial. We got to pull back here. The RSI is overdone, way overdone, and it looks like we may fill the gap. It's a short-term trade. I would be buying near the 51.50 level and exiting it right near all-time high around the 54 level. And if it breaks the 50-day moving average, we cut it. We're out of it. So again, Focus Financial Partners. Next one, InterDigital, right at the 50-day line. The RSI is grossly overbought. The stock has been making swing highs before bouncing. If it breaks a little lower, we get out. And if it goes, it can go all the way up to about 84. This is what I'm talking about. Low risk, high profit opportunities trades. Right at the 50-day moving average, so you'll know you're off. The RSI is oversold, and it looks like we can go higher. Again, the next few days, we got to be careful. Remember, as I said, we've got Fed data. So I'm expecting a subdued market going into tomorrow with volatility picking up right before the open as we have the GDP and Friday's employment. Watch the bond market carefully. If the bond market starts going higher, right, that means interest rates are going lower. If the bond market starts breaking down, that means interest rates are going higher. If interest rates are going higher, it's bearish for the tech and the speculative stocks. If interest rates go higher, it means bonds go lower to the 50-day line. It's actually fairly good for the blue chip stocks that are sensitive to interest rates like energy, basic material, industrial, and so forth, transports and so forth, the boring stocks. Boring versus fast stocks. So if interest rates go lower, all right, let's just go through this again. If interest rates go lower, why don't we do it this way? If bonds go lower, interest rates go higher. If interest rates go higher, weaker for the tech. If bonds go higher and interest rates go lower, it's better for the tech and worse for the blue chips. So again, higher interest rates, worse for the tech stocks, lower interest rates, better for inflation-safe stocks. Keep that in mind as we go into tomorrow's report. I probably said it backwards a few times. But again, higher interest rates are bad for the tech stocks and the speculative stocks. Higher rates are not as bad for energy, industrial, basic material stocks, because those stock prices, remember, basic materials, when inflation goes up, the prices go up with it. So that's an inflationary safe or low inflationary risk type of stock. All right, before I let you go, I've got something really important for you. Just because the market is unpredictable mess right now, it doesn't mean investors' financial situation has to be one, right? There's always, always, always sunshine in the stock market if you know where to look. And that's why one high-level trader, Jeff Zananeri, is sharing his greatest money-making strategy with you. He relies on a little-known market anomaly that could help traders just like you see incredible results with more strategic approach. What do I always say? Try to systematize, create a methodology. There's never, ever, ever been, and I mean that, there's never been a better time for investors to add this strategy to their toolbox than right now. Now, we know interest rates are going to rise. It's just a matter of time. But we don't know when or how fast. And that's the biggest factor. Now, Jeff's discovery centers around stocks and ETFs that are paired together. One generally outperforms the other in a big, big way. And it gives traders the ability to make moves in markets that are going up, down, or sideways. Imagine having a strategy that makes money in all different type of market cycles, but you don't need to know about crazy spreads or any of that crap. Easy, simple, clean, just the way I like it. Are you ready to find out how everyday traders, just like you, can take advantage of uncertainty in the market today? I sure hope so. Follow the link below, click on the link below, and learn about it now. You do not want to miss Jeff Zananeri's strategy. It is cool. This link trades is how professional hedge funds trade day in and day out, and Jeff is your ticket to showing you how it's all done. Follow the link below. Check out Jeff Zananeri. He is a powerhouse. And remember, if you're watching on YouTube, subscribe to this channel. Be the first to be notified when we post new videos. You don't want to miss out videos like this. And remember, be cautious and lower your exposure next 48 hours. It's going to be a crazy market. Talk to you guys soon.